Picture this, you're at the best party of your life. The music is perfect. The drinks keep coming. Everyone around you is having the time of their lives. But then you notice something strange. The host's best friends, the people who actually know how his finances work, are quietly moving their cars from the driveway to the street. They're not leaving. They're not making a scene. They're just repositioning. That's exactly what's happening in global finance right now. And the people moving their cars, central banks, the world's most powerful financial institutions, are quietly executing the largest wealth transfer in modern history, and they're doing it in a way that's designed to not wake you up. This is the story of the monetary prenuptial nobody wants to talk about. Let me paint you a picture of the financial landscape. The S&P 500 is near all-time highs. Bitcoin has solidified itself as a major institutional asset. AI stocks command valuations that price in a transformative future. On the surface, the engine of markets is running. If you're scrolling through financial news, everything can look like a green screen of wealth creation. Life on the surface is good. But here's what that same screen doesn't show you. Central banks around the world have been on a historic multi-year gold buying spree, not just a flash in the pan from the 1970s or 2008. This is a sustained, strategic shift happening as now in the background of every market headline. For 4 consecutive years, central banks have purchased over 1,000 tons of gold annually, a pace that has more than doubled the average of the 2010s. Let me say that again because it matters. The people who literally control the printing presses for dollars, euros, yen, and yuan are buying a metal that cannot be printed at a pace never seen before. When the people who create money start hoarding the thing that isn't money, you should probably pay attention. If you ask a central bank official why they're doing this, they'll use one word: diversification. It sounds responsible, professional, boring, even like they're just rebalancing a portfolio the way your financial advisor tells you to do once a year. But diversification is financial speak for something much more honest. It's the equivalent of someone quietly untagging themselves from all the couple photos on Instagram before they announce the breakup. The writing is on the wall. They're just not ready to make it official yet. 20 years ago, central banks held over 70% of their foreign reserves in US dollars. It was the unquestioned king, the global reserve currency, the safe haven. Today, that share has fallen to 57%. That might not sound dramatic until you realize what that 13 percentage point drop represents in actual dollars. We're talking about a multi-trillion-dollar shift away from exclusive dollar reliance and into alternatives like gold. Gold is now the second largest reserve asset in the world, and it's gaining fast. This isn't a sudden panic. This is a slow, methodical, deeply intentional exit strategy. So why now? Why are the people running the global financial system quietly heading for the door? The answer is uncomfortably simple. The math has stopped mathing. The United States national debt has surged past $43 trillion. Not million, not billion, trillion with a T. That number is so large it's almost meaningless to the human brain, so let me give you some context. If you earned $1 per second, it would take you over 31,000 years to earn $1 trillion. The US national debt is 43 of those. We are currently adding to that debt at a rate of nearly $2 trillion per year, which means we are deficit spending at a pace of over $63,000 every single second. Every single second. But here's where it gets truly problematic. Borrowing money isn't free. You have to pay interest. And right now, the United States government spends well over $1 trillion annually. Projections put it at $1 trillion just servicing the interest on the debt. Not paying it down, not reducing the principal, just keeping the lights on. To put that in perspective, we now spend more on interest payments than we do on national defense, more than veterans' benefits, more than income security programs. We are spending more money on the cost of past borrowing than we are on protecting the country or taking care of the people who defended it. Central banks are looking at this and doing some very simple math. If the US continues on this trajectory, there are only 3 possible outcomes. 1. Massive spending cuts and austerity, which is politically unthinkable in the current environment. 2. Massive tax increases, which is also politically unthinkable. Or 3. The Federal Reserve eventually steps in and prints money to help finance the debt, which devalues every dollar in existence. That third option is the silent killer. It's slow, it's easy to deny, and it's exactly what central banks are trying to protect themselves against. Gold is the insurance policy. Here's an uncomfortable way to think about it. Imagine the United States government as a business. Not as a country, not as a democracy, but as a business with a balance sheet. That business has not turned a profit since 2001. For over a quarter of a century, the US has spent more than it has taken in, every single year. It doesn't matter who's president. It doesn't matter which party controls Congress. The business loses money. Now imagine you're a foreign investor looking at this business. You're China or Japan or Saudi Arabia or the European Central Bank. You've been lending money to this business for decades because it was the safest, most stable investment in the world. The business had the strongest military, the deepest financial markets, the most innovative economy. You trusted it, but now the business is $43 trillion in debt, losing nearly $2 trillion more every year and spending $1.4 trillion just to pay the interest on past mistakes. The fundamentals have deteriorated, the path forward is uncleared. You don't want to pull all your money out at once, because that would crash the system and destroy your existing investments. But you also don't want to be the last person holding the bag when the music stops, so you diversify, slowly, quietly, strategically. You buy gold. But here's where this story gets truly strange. Because while central banks are quietly positioning for instability, the markets are screaming the opposite message. Stocks are priced for perfection. AI companies are valued as if artificial general intelligence is arriving next Tuesday. Risk assets are in full party mode. Retail investors are piling into speculative trades with confidence levels that would make a crypto bull from the early 2020s blush. At the same time, gold is hitting all-time highs. Historically, this doesn't happen. Markets pick a lane. Either we're optimistic and stocks rally while gold sits quietly in the corner, or we're terrified and gold explodes while stocks collapse. Both don't surge simultaneously, except they are. Right now, we're living in a world where stocks are priced for unlimited optimistic growth, gold is priced for a deeply uncertain future, and bonds are just priced for total confusion. The dissonance is deafening if you know where to listen. This is the market equivalent of someone smiling for a photo while texting their lawyer about a prenup. The surface says everything is fine. The subtext says someone is hedging their bets. Gold doesn't rally when people feel safe. Gold rallies when the foundation starts to crack. It's the asset that doesn't need a business model. It doesn't need to generate cash flow or pay a dividend or disrupt an industry. It just exists. It's been valuable for 5,000 years not because it does something, but because it is something. In a world of easy money, printed currencies, and balance sheets held together with monetary duct tape, gold is the hard asset. The thing that can't be conjured into existence by a central bank meeting. So let's connect the dots. Central banks are buying gold at record levels. The US debt is spiraling into territory that has no historical precedent for a reserve currency. Markets are acting like everything is fine while also acting like everything is not fine. What's actually happening here? Central banks aren't reacting to a crisis that has already occurred. They're positioning for the one they see coming. This is preemptive, strategic, quiet. They can't sell all their dollar holdings because that would trigger the very crisis they're trying to avoid. If China dumped $1 trillion of US treasuries onto the market tomorrow, it would crater bond prices, spike interest rates, and potentially collapse the global financial system. They'd destroy their own remaining investments in the process. So instead, they're tiptoeing. They're buying gold with the new money that comes in. They're letting old treasury positions mature without rolling them over. They're shifting the composition of reserves slowly enough that it doesn't trigger alarms. Think of it like someone who's planning to leave their spouse but hasn't filed the papers yet. They're opening their own bank account. They're moving money into assets only they control. They're having quiet conversations with lawyers. They're not causing a scene at Thanksgiving dinner, but they are absolutely preparing for a different future. The goal is to build the bunker before the storm hits, to have the insurance in place before the fire starts, to own the hard asset before the currency crisis makes it unaffordable. Here's what makes this particularly unsettling. The people buying gold right now aren't retail investors watching YouTube videos about the end of the dollar. It's not conspiracy theorists or doomsday preppers or your uncle who thinks the government is hiding aliens. It's the Bank of China, the Reserve Bank of India, the Central Bank of Poland, the National Bank of Poland, the Czech National Bank. These are institutions staffed by PhD economists, career bureaucrats, and people whose entire job is to think about monetary stability 50 years into the future. When the smartest, most informed people in the global financial system start quietly preparing for instability, that's a signal. It might be a wrong signal, but it's not a signal you ignore. And yet most people are ignoring it because gold is boring, because the stock market is fun, Because the economy still feels okay if you're not looking too closely at the interest expense line on the federal budget. But here's the uncomfortable truth. Every major financial crisis in history was preceded by a period where everything felt fine. The housing market was booming in the mid-2000s. The dot-com party was raging at the turn of the millennium. The trick with financial crises is that they don't announce themselves. They build quietly in the background while everyone is distracted by the thing that's working. And by the time the crisis becomes obvious, it's too late to prepare. Let's zoom out for a second. What we're actually witnessing isn't just central banks buying gold. It's the slow, grinding erosion of the post-World War II monetary order. For the better part of a century, the US dollar has been the unquestioned center of global finance. Every major commodity is priced in dollars. Most international trade is settled in dollars. Countries hold dollars as reserves because dollars are liquid, stable, and backed by the full faith and credit of the most powerful nation on earth. But that system only works if everyone believes it will keep working. It's a confidence game. The moment central banks start to doubt whether the US can manage its debt, whether the dollar will hold its value, whether the Federal Reserve will remain independent, the moment that doubt creeps in, the whole structure becomes fragile. Gold buying is doubt made tangible. It's central banks saying, without saying, that they no longer have complete faith in the current system. They're not betting on collapse. But they're not betting on smooth sailing either. This is what hedging looks like at the nation-state level. And if countries are hedging against the dollar, what should you be thinking about? So here's where we end up. The party is still going. Stocks are still climbing. The music is still loud, but the people who know how this party is being financed are quietly repositioning their cars. Maybe they're wrong. Maybe the US figures out a way to grow its way out of the debt without triggering inflation or a currency crisis. Maybe artificial intelligence generates so much productivity that tax revenues surge and the deficit shrinks. Maybe we're worrying about nothing, but maybe we're not. The central banks buying gold aren't idiots. They're not making a mistake. They're reading the same data you have access to and coming to a conclusion that should, at minimum, make you pause. So the question isn't whether the dollar will collapse tomorrow. It won't. The question is, if the people who print money are buying the thing that can't be printed, what does that tell you about where they think this is headed? And maybe the better question, when the smartest people in the room start moving their cars out of the driveway, do you stay inside and keep dancing, or do you quietly walk outside to see what they're seeing? Because one way or another, this party doesn't last forever. And when the bill finally comes due, the people holding gold are going to be the ones who planned ahead. The dragon is still sleeping, but it's starting to stir. And that's not a problem for today. That's a problem for the person who's still at the party when it wakes up.